Welcome to today's deep dive. We're looking at a new private IQ research report on StashAway today.
Right, a major digital wealth management platform operating across Southeast Asia and the Middle East.
Exactly. And our mission today is really charting how a robo-advisor actually transitions from a cash-burning startup into a profitable financial institution.
And what that evolution means for how you manage your own portfolio.
Yeah. Okay, let's unpack this because the report highlights a massive fiscal year 2024 milestone.
Oh, the EBITDA numbers.
Yeah, their mature Singapore operations actually hit a positive EBITDA of 1.4 million Singapore dollars.
Which is a milestone that answers the lingering question for this entire sector. Can a digital wealth platform actually generate real returns, or are they just permanently stuck subsidizing user growth with venture capital?
And the data tells a really compelling story here about decoupling growth from ad spend.
Right.
Because in FY24, their Singapore revenue jumped nearly 45% to $11.3 million, while marketing expenses barely moved. I mean, they were sitting at just $0.84 million.
What's fascinating here is that this perfectly illustrates the concept of scalable operating leverage.
They hit a saturation point.
Yeah, they've reached a point in their home market where they don't have to aggressively buy every single new user. The engine is now fueled by brand recognition and existing clients pouring more of their wealth into new product tiers.
You can see that client stickiness in the proprietary data from Private IQ too. They assigned StashAway a smart score of 3.7 out of 5 and an alt data score of 3.5.
Which essentially measures their competitive momentum.
Right. But the standout metric is their product affinity score sitting at 4.2.
That's high.
Very high. For a wealth app that implies users aren't just parking money, they're actively engaging with the ecosystem and trusting it with larger shares of their net worth.
If we connect this to the bigger picture, that deep user affinity is the key to their upmarket shift. They are going aggressively after the missing middle.
That emerging affluent bracket.
Exactly. That $1 to $10 million net worth bracket, often underserved by top-tier private banks. Through their StashAway reserve tier, they are opening up access to private equity and venture capital.
Partnering with institutional giants like Hamilton Lane and KKR.
Yeah, and by doing that, they've managed to drop the standard private equity entry barrier from $250,000 down to as low as $20,000.
So we're moving way beyond basic ETF portfolios here. Driving these allocations is their ERAA framework. It's an automated system that shifts portfolios based on macroeconomic trends.
But handing the wheel to an algorithm creates some unique edge cases.
It definitely does.
This raises an important question about the risks of active automated management. The report details a pivotal moment when StashAway's system triggered a massive sell-off.
Slashing its China tech allocations to near zero.
Right over geopolitical and secondary sanction fears. That was a highly contrarian move while competitors just held tight. When an algorithm makes a bold call that diverges from market consensus, it puts immense reputational strain on the platform if it turns out wrong.
And the operational risks go far beyond algorithmic trading too. The report details a pretty intense situation where malicious actors were impersonating StashAway on WhatsApp to solicit fake investments.
Oh yeah, that was bad.
It escalated to the point of police involvement. The company's CTO had to personally dig into the architecture to definitively prove to users there was no underlying data breach.
It highlights how fragile trust can be when dealing with a digital-first platform. The moment a user suspects a vulnerability, the entire model is at risk.
And the stakes are only getting higher as they court wealthier clients who demand institutional-grade security alongside those institutional-grade returns.
Which brings it all back to you and your portfolio.
Exactly. If you have capital sitting in low-yield bank deposits, understand that these digital platforms are rapidly building sophisticated tools to pull your business away from traditional institutions.
But that blurring of lines between a retail app and a private wealth manager is interesting.
It makes me wonder about the long game. As these digital disruptors successfully capture high-net-worth clients and offer complex private market assets, will they eventually be forced to adopt the exact same bloated operational costs and fee structures of the legacy private banks they originally set out to destroy?
That is a very real possibility.
Something to mull over. Thanks for joining us on this deep dive.